Don't wait for tomorrow. Live for today. Keep chasing the sunshine and go out and play.
Good day, good evening, everyone. Welcome to probably the most magical deal reveal you will ever witness. For those who don't know, these deal reveals are meant to show opportunities, U.S. real estate investing at its magicalist, right? At its most magical. And today, we literally have one of the biggest giveaways we can for you, an opportunity to work with us in Florida on this or deals like these ones. We are starting to open up the doors for people who want to invest with us, with JK, in the US. So this is super, super exciting. We're very, very excited to have you be a part of the excitement. You've been seeing on Facebook, and we've been trying to post as much as possible. We're spending a lot of time trying to show you what we do, how we do it, and so that you can get involved too. So if what I say in these deal reveals is exciting to you, just send us an email, info@nowfortomorrow.club, and we'll get you in the queue. We'll have a conversation with you. We'll take a look at your needs, see if it lines up with everybody's needs on the call, and we'll take it from there. No obligations, obviously. So today we're getting very, very excited because we got this property in Davenport, Florida, asking $1.25 million. Myrtle Wood Street, Davenport, and we're going to take a look at this from a slightly different perspective from the normal deal reveal. And I want you to give us some feedback on this particular format of the deal reveal. Let us know if you like this more than what we've been doing for the last couple of years. We are always growing, always changing, and we want you to we want to give you what you want. So let us know if this is more of what you want. So let's take a look at this property. $1.25 million. What do we buy in the US for this? Well, we can buy the Wizard's Way. Wizard's Way, ladies and gentlemen, this 8-bedroom, 5-bathroom property, the original Harry Potter house in Florida. This is not the one that we created. This is the one that was there about 5 years ago, and they've been doing amazing. And they recently put it for sale, and guess who went in there, started negotiating, and ultimately got an accepted offer at over $100,000. So, and we're still recording. All right, wonderful. So I was saying that we have a $1.25 million opportunity in Florida. It's called Wizard's Way. Wizard's Way is the original Harry Potter house. It's not the one we created. It's not the Magical Muggles Mansion. It's Wizard's Way. They've been in operation in the Orlando, Davenport area for the last 5+ years, doing amazingly well. And they decided to shift their business model, and they put their properties up for sale. And so when we saw this, we immediately jumped on the opportunity and got this bad boy under contract for over $100,000, well, under $100,000 from the asking price. So this property is under contract right now, and we have an opportunity for you. Take a look at this Wizard's Way. All right, this is the original inspiration for so many other Harry Potter houses worldwide. Pretty amazing stuff. They did an excellent job pulling this off and an excellent job marketing it as well. If you go on ChatGPT and you type in what are the top 5 Harry Potter houses in Orlando or in Florida, this comes out as number 1, and ours comes out as number 5. Not bad for only being running for 1 year. So we definitely got something going on here. Very, very exciting indeed. And so let me just pull up our presentation one more time here. And so today on our deal reveal, I want to show you this opportunity and how it could translate to you. Would you like to own a piece of the original Harry Potter house in Florida with JK, because that's what we're talking about here. That's what we're giving away today, okay? And so rather than the usual 50% rule, and you'll see how the 50% rule, you could play on it yourself and you'll see it's pretty accurate. But I actually wrote up an entire dashboard, the entire number cruncher here, where I put in all of the information, and I wanted to show you a little something. You know, in the normal deal reveal, we talk about cash flow. That's basically what we're talking about. We're talking about a cap rate, we're talking about a cash on cash return, but real estate has so many other wealth building elements that we don't even talk about in the deal reveal usually. And that could skew how you might look at an opportunity like this or other opportunities you're looking at. Because you have ultimately the ROI and the IRR, the internal rate of return of an investment property. And that's what I wanted to dive a little bit deeper in today to show you. It's not just about the cap rate. It's not just about the cash on cash return or the, there's also the IRR. And that might put some things into perspective for you. So here, let me just run through the numbers real quick. So we got this 4,000 square foot property generating about $20,000 a month, $240,000 a year is kicking off this. And there might be opportunity even to create events. We just got a wedding request on our Magical Muggles mansion. The person is super crazy, overjoyed. They want a magical Harry Potter wedding, and they're coming to us to see if we allow events and if we offer catering. And the answer is absolutely. All right. So one event like that could cover the month, what a normal month would be. And you want to get as many of those. When we're dealing in, say, Florida, when we're dealing anywhere, property appreciates over time. Now, in the deal reveal, we completely ignore this appreciating element. We just look at the cap rate. But if you're in a market like Florida, you know, went up over 10% in the last couple of years, especially through COVID and so forth. And so putting a 5% appreciation rate is not crazy. It's actually quite conservative in Florida specifically. Yeah, if you're in Ohio, maybe you dial that down to a 2 or 3% per year. But if you count that in, your numbers can look radically different than the cap rate. So we have our down payment, 30% down with our, an 8 point something interest rate, a DSCR loan. And ultimately, we're going to come up with about an $800,000 mortgage. And we have our property taxes, insurance, utilities, HOAs, property management, repairs and maintenance. We put in all of our expenses here. And then we come up with some pretty interesting numbers. This property is above a 10 cap. All right. So if you've been on the deal reveal, you're like 10 cap. Okay, it's like it's good. It's good. It's not a 20 cap. It's a 12 cap. So but in Florida, and for this price point, right, 1.25 or 1.148620, that's a pretty strong cap rate. Then, because we're getting financing and we're leveraging into this opportunity with 30% down, it's actually a 21% cash on cash return just from the cash flow alone. Because we don't have to bring 1.15 million to the table, we're only bringing 350. And the cash flow after mortgage is 76,000 a year. Well, that's a 21% return from the cash flow alone. So that's usually where we stop at the deal reveal. And then you make a decision. Is a 12 cap and a 21 cash on cash return, is that a deal or no deal? That's usually what we do. But there's more happening in real estate, isn't there? The property appreciates. You depreciate the property most likely on your taxes to not pay, income tax on a good chunk of that income. Over time, you're paying down the mortgage. You're increasing the rents, or just inflation makes it that your nightly rates can increase over time, over a 5-year, 10-year, 20-year period. A lot of your expenses stay quite fixed, but all those things are playing in your favor and giving you some different unrealized returns that you can realize shortly, in a couple of years. So let's take a look at some of the other metrics. So we understand a cap rate. What's the return on this investment if you bought the whole thing cash at 1.15 million? And then we have the cash on cash. If you buy with financing, You just put a down payment and you're making all this cash flow. So every dollar you have in the deal, because it's leveraged, is now making 21%. But if you factor in appreciation, principal pay down, right? All these other things, this is actually a 44% IRR, internal rate of return. And so if you really look at the entire deal, this is the slightly more relevant medium-term perspective, but real number for the annual return on this property, right? And if you've ever seen these metrics before, the debt service coverage ratio at 2.0, we can pay twice the mortgage on this thing because the income is so strong. In 5 years, the gross rental income covers the purchase price. We could have a mortgage of 18.5% and still break even, right? But we get involved in fixed rates much lower than 18.5%. So even if the market does double in rates, our payments won't double or we won't go underwater, right? So we've got all these things. But the bottom line here is that this property has an internal rate of return of 44. This is the pro forma. These are the numbers that are projected. They're real, but they're also projected because once we buy, and who knows, but 44%. And we are ultimately giving 50% away of this deal to equity partners. So if you're interested in this type of a deal, we can have a conversation, and we're giving 50% away to passive investors. And so the internal rate of return would be half that. And so 22% is ultimately the ballpark of where your investment could go. And for those of you who understand what I'm saying here and who maybe attended the blueprint or heard about how we pioneered a trail to use your RRSPs, right? That capital, right? That $100,000 or $250,000 investment could come from your RRSPs, ultimately costing you 2%. There's only a 2% ongoing annual fee on those RRSPs, and you are growing your RRSPs in the process. So there is some incredible opportunity here. I hope you enjoy this opportunity. And if you have any questions, or if you like this type of deal reveal where I go a little bit more in detail, well, be sure to share with us in the comment or by email. We want to know if this is more what you're looking for and giving you what you want. There's been more and more people coming to us wanting to work with us, wanting to be passive. And so we are trying to give you what you want, shifting it, moving it around. So with all this being said, is this a deal or no deal for you? Let's hear it up in the chat, in the Q&A. Is this a deal or no deal? And will we be getting a message? Will the JK team be getting a message from you to ultimately see if this is a fit? There is quite a tight timeline for this. So if you are truly interested in the opportunity, don't delay. We've already had quite a few conversations, and it's a first come, first serve basis. So we have a 10 cap base property, 10 plus cap, a 20 plus cash on cash return, an internal rate of return of 40 plus, and we haven't even talked about the refinance because we are planning to do a refinance in 5 years. So if the property takes 5% value appreciation over 5 years, it'll take 28-ish% in value. So we've created an equity margin there to refinance, get the money back out. And so now there's nothing left in the deal, or very little left in the deal, so that our new IRR post refinance in 5 years time could be over 100% IRR, 100%, because you have little or no money left in the deal and you still keep a percentage of the property. So up to 5 investors on this deal maximum, and each bringing in 100,000. That is the ask happening right now. And if you're interested in this, we will have until next Wednesday to take your emails and have a meeting with you to see if it's a fit, because it's under contract. We already had it inspected. It came back basically flawless, like $2,000-3,000 worth of little deferred maintenance, which is nothing on $1 million+ property. The financing approval is in place. Everything is golden on our side. So now it's just a matter to see if this is a fit for you and your real estate goals. I will say, I forgot one thing. For every $100,000 invested, you get a week of personal use time in the property as well. In the slow season, we don't want to take on Christmas where we can have $2,000 plus a night, but we're throwing in a personal use week for each $100,000 slice invested. So you have a 44% IRR pre-refinance, 100% maybe up post-refinance, and an extra week. Just that week is worth $5,000 to $7,000. All right. So just the week could be worth a decent investment of about 7% return. Just the extra week on top of everything else we mentioned. I mentioned today. So that's some of the mathematics of U.S. real estate, and especially with a nice Harry Potter theme. Imagine having a piece of the monopoly of the Harry Potter franchise in Orlando, right around Universal Studios and such. For those of you who don't know, Universal Studios are building a third park, and in this third park, there is another Harry Potter land. So every single theme park will have a Harry Potter land, and so the Harry Potter franchise is not going anywhere. And Florida in general has the highest immigration rate, internal inbound immigration rate in the US for any US state. There's a ton of people going to Florida, which is only going to continue to increase property value, increase demand for housing and short-term rental housing in Florida, not to mention the train being built, etc., to facilitate travel in state. So a ton of reasons to get excited about this and US real estate in general. So deal or no deal, I have here, a few little questions here. Amanda's asking why the 0% vacancy rate? Simply because the 20,000 a month is a real number. This is the actual number that they've been running at for the past couple of years. So I'm not projecting an ADR of $1,000 a night, which would bring $365,000 a year, but only a 60% vacancy rate to bring it back down to 240. 240 is the nightly rate. It's just the number. That's why the vacancy is at 0. So this is buying a property with history, rental history. We're not buying a pro forma where we know that the market, maybe on AirDNA, we know the ADR is a certain amount, and now we have to factor in vacancy to see what the real number would be. And Sukhvinder, please repeat what the 50% amount is in this case. The 50% amount in this case. Okay, what did I say, 50%? I mentioned a 44 and a 40%. Sorry, Sukhvinder, I'm not sure what 50% you are referring to here. Oh, the 50% rule maybe at the start. Well, typically, if we just want to use some quick numbers and take a look, let's do them. Quick numbers. If we use the 50% rule on this, we have a $240,000 a year in gross rental income. 240,000. Let's bring this. And if we use the 50% rule, we'd say basically 50% of that is expenses. So there's 120,000 coming in net income. And so if this is the net income and you're paying 1.15 million, we're at a 10.4 cap, okay? And the actual cap is closer to a 12, right? So that's the 50% rule at play, giving you an approximate 10.4. And here we have a real 12. So the 50% rule is typically more conservative than the reality, which is good as a trick, so you don't overpay for something. And we are in an outlier property right now. This is not a typical type of return, 240,000. And so because of that, we have a lower operating expense here. We're closer to 40% operating expense instead of a 50%, which is the 50% rule. So when you get to very high return, high reward yield properties, these quick tricks might not apply as well, but it's still a conservative way to look at it through and through. Excellent. Another question coming in is how much investment from a partner So it's a minimum of 100,000 US per partner, up to 5 partners total. One person can bring the whole thing, or 5 people can bring 100 US each, and they can also come from their RRSPs. Oh, and the question for 50%, I guess, is the equity piece, right? So we're giving away 50% of the entity that will buy this property. 50% of the entity that will buy this property is going to the person or the people who are bringing those 100,000 or 500,000 total investment. And yes, Daniel, absolutely, 100K is 10% equity, and so 200K would be 20%. 500K is the whole 50% equity. Perfect. Absolutely. Yeah, okay, great. So there's a bunch of questions, but they've all answered themselves. So that's fantastic. Good job. Absolutely. So if you have any other questions, reach out to us, book a meeting if this is of true interest for you. We already have a few calls in the line. This is as educational as an opportunity. We would like to have more opportunities like this to present. And one last question, it's a pretty important one. What's the minimum number of years investment? It's meant to be a long-term play, but we certainly have in mind this 5-year mark to do a refinance. Ultimately, as soon as we can refinance, we will, to give the money back, because that's when the IRR, that's when the return on investment skyrockets, is when you're able to get your money out, keep some cash flow, and do it all over again. So as soon as we can refinance, we will. And just based on a 5-year appreciation alone, 5 years will create that equity margin to refinance, get the money back out, and keep on going. So let's line up 5 years. There's other reasons for the 5-year also. We're getting into financing into this property. And so there won't be any penalties to refinance after 5 years, because usually it's a 5-year step down penalty, meaning if you tried to sell or refinance again in right, that's $50,000 plus on this, or right around, no, it'd be $40,000 on this deal. And if you did it in the second year, it'd be 4% penalty, etc. So after 5 years, there's no penalty. And also the same thing applies if people are using their RRSPs. There's no penalty or anything if they pay them all off after the 5-year mark. So after the 5-year, we can refinance, get the money back out. The investors can use their RRSPs, clear off their RRSP loan paperwork situation without any penalties as well. And now they've replenished their RRSPs and they can do it all over again if they want. So that's another reason for the 5-year mark. So this is a 5-year mindset. Heck, if we get another COVID and the prices jump up, yeah, and interest rates go down, yeah, we'll consider refinancing again. But the idea is RRSPs are already locked in for probably 10, 20, 30, 40 years for some of you. And so it's not hurting any of your liquidities to access that capital. And so whether it's in for 5, 10, 15 shouldn't hurt you, shouldn't bother you, because now you're double tapping those RRSPs and you're accessing an internal rate of return of 20% on RRSPs that may be yielding you much lower than that at this time. So with that said, that's our deal reveal for today. I hope you enjoyed it. And again, if you have any questions, or if you would like to book a time with myself, Janie, or anybody on the team regarding this opportunity, it's as simple as info@nowfortomorrow.club. Hope this was helpful. Have a great evening. And for those of you on the mastery call in half an hour, we're going to go through this deal again, but even deeper on the numbers. So stay tuned. Looking forward to seeing you there. Have a great one.